Good evening, everyone. Great to have all of you with us. I wanted to get started with an overview, really, of the fund, how you go about the selection process, what your outlook really is. It's a lot of questions all bunched into one, and I know all of you will add a different perspective. But to begin with, Nitesh, let me come to you. If you can share with us really an overview and why the small cap fund, what the thought process is, and then we can dive in from there.
So essentially, since last 1 year, the small cap fund, the Aditya Birla Small Cap Fund, has been managed by the analyst team. And as you may be aware, as a team, we are like 10 people covering different sectors. I am a sector generalist covering the mid and small cap stocks, apart from a couple of sectors. Effectively, what we have done as a process is a certain allocation for each and every analyst is there, and only the high conviction absolute return ideas are part of that portfolio, and it brings 10 minds together, and to get the maximum out of it, this is the target. And broadly, we are on track. The team collective efforts are now visible. And compared to, a bigger change is that instead of mirroring the small cap index, now we are focusing more on the absolute return bottom-up ideas. Yeah, that's all.
Okay, great. And we're going to talk more about that in a lot more detail, get into specific sectors as well with all of our guests here. But continuing with a sense of the overall picture, Chanchal, let me also come to you on that, because would love to learn a little bit more about the process and taking off from where Nitesh left off.
So thanks, Abha. So investing in the small cap, the most important thing which we evaluate, and that bigger importance is given to the management quality. It's very important to back on the right management and the right business. We have an internal process wherein we have a management scorecard, and we give various buckets where we define how management is on various buckets, right from the accounting policy to quality of disclosure to quality of board and the team, and the financial discipline and capital allocation. We have a set of a benchmark, and we evaluate all the management based on this benchmark. To define few things from this benchmark, accounting policy, the more conservative the accounting, the better it is. So to give you an example from a retail sector, if our management is more conservative in his accounting for the inventory, and if he follows a consistent policy, we give him a heads up. The other important point, when we invest in a small cap company, we talk to their entire stakeholder, be it the customer, be it the employee, or be it the supplier to them. We get and the competition. We get to know the in-depth analysis of the company from that perspective. As Philip Fisher has coined the word settle but investing, this helps us get into deeper on the company. The other important point where all the analysts focus on the earning growth, the underappreciated thing is the capital allocation. The most important thing, in fact, I would say the capital allocation. If you're generating a huge amount of cash flow, where are you allocating those cash flow? Are you investing in the right sector, or are you diversifying into the sector which is not complementing your sector? So capital allocation becomes a very important thing. The other learning which we have from last 4-5 years is when you are looking at the company, you should also look at promoter pledge, and why is promoter raising money if he's raising money for other businesses which he has. I can give you example of a media company or of a pharma company or of a FMCG company where promoter pledge and raise money for different businesses. So it's very important to see promoter leverage and how this is allocating the money raised from the pledge. So these are important things we look for while evaluating a management.
Wonderful. Dhaval, investment is, of course, more about the process and following it with consistency. So tell us a little bit more about the process as well. We'd also love to hear from you.
So thank you, Abha. And I think Nitesh and Chanchal has covered few points really well. So maybe, first of all, very good evening to everybody. Just to tell you, on the outset, we follow an investment universe concept. And what do we mean by an investment universe, right? The investment universe at Aditya Birla Sun Life AMC, we have close to 380 companies, which is largely covered by the 10 analysts. So approximately 35-40 companies each, well covered. We have to focus on getting detailed financial model analysis. We discuss these companies, and not at any point in time that any particular company can be introduced in the universe. So there is a thorough process where a company is discussed, whether it's an IPO or a new ideation. The analyst role, right, doesn't end only at ideation or bringing the company in the universe, which thoroughly goes with discussion with the entire fund management team. But it goes, the real work begins there. Means we have to have a review process, which has been our discipline for now almost 8-9 years, where every Monday we have a portfolio managers meeting, and every fortnightly Monday we have evening analyst universe as well as analyst recommendation meeting. The point I'm trying to emphasize here is that these are the meetings which have been followed by now almost 9 years on a constant basis, to just keep refining our investment process and keep analyzing the companies in a very detailed and consistent manner. And what goes without saying is that we keep meeting the companies very regularly. Once in a quarter, we follow up for every quarterly performance of the company or other corporate developments. And above all, COVID crisis has helped to get a consulting or a channel checks done across sectors, across companies really well. Means we can get into, without wasting time, get into any corner of the world these days to understand more about the companies we research. So that is the key crux on investment universe and the philosophy we have. I think in the previous 2 sessions, both Mahesh and other senior fund managers have mentioned, on a house basis, we've tried to follow GARP as an investment philosophy, which is growth at a reasonable price. Definitely multiple fund managers would have different styles, but this is our key view, how we manage our money.
Awesome. And it does sound like quite a detailed process, and one that you're constantly working on and evolving as well. Kunal, tell us, how the analyst team is managing the fund. I mean, I know we've already got a lot of perspective from Dhaval, Nitesh, and Chanchal, but, in terms of, again, the kind of process you're following, anything else that you'd like to add before we dive into the sectors that all of you individually track? Kunal, I think you're on mute.
Sorry, my bad. Yeah, thanks, Abha, for that question. So actually, from a managing the fund perspective, let me tell you, just before that, we went back and what we've, in terms of the, refocusing on all the companies, as Dhaval said, we have the whole investment universe. What we did is that, revisited all the companies across the investment universe, define the narrative. Now, in investment parlance, what is important is that, the narrative for a company should, is what it has to, well-defined narrative, basically tells the moat of the company and highlights the key strengths. The way we did is that, we bucketed all these companies into, 5 categories. One will be in terms of the fast growers. The second was in terms of the slow growers. In the third, in terms of the cyclicals. Fourth were, the kind of turnaround plays. And the fifth one in terms of the, high asset players. So that it helps us in terms of categorization. It helps us in terms of categorization of the company, define the moat of the company, and accordingly, we can construct the portfolio. So over the last, as Nitesh highlighted, so we, as the team, all 10 analysts, we've taken over, we've started managing slightly less than a year back. What we did is that, first is revisited, revamped in terms of the narrative for each of the company. Then obviously, with regards to, the changes that were required. So first 4 to 5 months, we just, changed the portfolio, reconstructed the portfolio. And then over the last, 6 months, we've seen that, all the efforts of all the, joint efforts by all the analysts is getting to some extent, starting to get reflect. The idea is that, not to have a, particular benchmark. It's about more giving specific allocation, get the best ideas in the portfolio from each of the analysts, And essentially, it should be the high conviction idea which should start getting reflected in the portfolio on an absolute. So the idea is that absolute return basis we should try and achieve this portfolio where basically we have a high absolute return stocks. And the approach is very much flexible in a way to accommodate more ideas if high absolute higher absolute return ideas are there. Probably you add that into the portfolio. So to conclude, I want to highlight one point to our investors and partners that there is a change the way we look at the whole small cap portfolio, and collectively we are working to make this a success, and it's a matter of time before we see the results.
Absolutely, I'm sure it is. And in fact, I wanted to ask all of you that because now you all track your individual sectors. So I'm curious to know, what really you feel is the opportunity for the next decade when it comes to some of the names that you're tracking, particularly in the small cap universe. So many times we get the argument that there aren't enough quality stocks, in that universe. And I think that, however, on the other hand of this debate is the fact that that's really where the opportunity is for multifold growth, to find the next multi-bagger. So I'd love to get your views and maybe even pit you against each other to find out which sector you really feel is going to be the more exciting one. So, Nitesh, should we start off with you and get a sense of the forward-looking outlook, the kind of subsectors within the small cap universe, perhaps where you feel the maximum opportunity is? I know that you also individually track certain sector funds, but we'll come to that later. But first, in a more general manner, some of the subsectors or niches that you are tracking.
Yeah. So thanks, Abha, for the question. Before we go to the subsectors and the specific areas, I would like to summarize the views on the entire basket. The mid and small cap basket, which has been very exciting for last 6 months. Effectively, if you look at the broader spectrum, ever since, even before the COVID crisis hit the markets in March of 2020, the entire mid and small cap were already in bear market. They peaked in December 2007, and the entire 2018, 2019, they were actually grinding down. As in the previous forum, some of the senior fund manager mentioned, there were multiple shocks and events which happened in India in last 4 years, right from Demon to GST to then IL&FS crisis in 2018, and then finally the COVID crisis. The fact here is the companies which survived these shocks are now there, and they are the strongest of the lot. And therefore, I think they should stand to benefit over a long period of time. One more thing here, I would like to add, in globally also, the small caps as a basket has started outperforming the large caps. So if you look at the Russell 2000 index in US, 6 month return of Russell 2000 index is 47%. Versus 17% for S&P 500, the large cap index. Similarly, in India, the Nifty small cap index has outperformed Nifty over last 6 month period. And one more thing I want to mention, which is very, very interesting to know, that the entire 2020 has been broad-based rally. Okay, to give some numbers here, for example, in the BSE 200 index, in 2017, only 5 stocks accounted for 75% of the gains. In 2018, it was only 6 stocks which accounted for 75% of the gains of BSE 200 in that particular year. In 2020, that number became 25. So basically, it suggests that it has been a broad-based rally. And typically in an economic expansion, mid and small cap tend to outperform large caps, and they tend to do very well. One technical point I would like to highlight here, and which is very relevant and from a market angle, unlike in December 2007, we have absolutely no leverage in the system at this point in time. People are not greedy at this point in time. The positions are light, and we had a complete clean off in March 20 when the fall happened. So my sense is that as a category, as a basket, with such kind of structural setup, it is very hard to believe that the rally is going to be over in 6 months time. I think there are some more legs to it.
Okay, fantastic. So lots of excitement up ahead for sure. Um, Chanchal, let's talk about the consumer space specifically, and get a sense from you on what the opportunities are there. We've seen a lot of digital adoption, of course, across the board. Do you think that the offline versus online model will play out? So we'll start to see a lot more. Online players. Do you see that? Do you feel it's still undecided? What are the key trends that you feel will evolve in the space?
Thanks, Abha. So, a lot of things have changed post the pandemic in the consumer space. If I were to highlight few things, one has realized how working out of home is very important and how home will play an important role. Most of us are taking this the entire panel from home. So the home will play a very important role. People invest in their home. So home improvement as a sector will play a very important role. If you look at consumer durable as a basket, the penetration of consumer durable in India is hardly 20%, 20-25%. So this is one space we are very bullish about. Next 10 years, next decade, you'll see a huge growth. In fact, 15% CAGR growth for next 10 years in the entire home improvement consumer durable space. That's one big bucket which came out of this pandemic and which will continue. The other big bucket is that people have realized the importance of health and hygiene. All of us have realized that how important it is to build your own immune system, to eat healthy food. People will move to organic and natural. People will look to reduce their sugar consumption. New categories will emerge. In this background, the MFD as a category will play a very important role. So that health and hygiene, whoever is able to play that category will be the winner in the next decade. The other important thing, Abha, is that when we normally eat out 5 to 6 times in a month, I'm talking about pre-pandemic, if not more, right? What people have realized that why not have food at home? Why not order online at home? So QSR will play a very important role. I'm talking about quick service restaurant. People will look to order food online and eat home at least once a month or not, if not twice a month. And the other thing people have started doing is a lot of car travel. People have moved to 500 kilometers, 800 kilometers by car. And when you're traveling by car, you have to stop somewhere, pick up a food and just move ahead. So QSR, as in India, car travel will develop. QSR as a space will develop. That's the third big bucket which I think will develop. And the fourth one, which you highlighted, people had said that Kirana as a channel has died down. Kirana is finished. Online and offline will play a role. But it's not about either or. It's about 1 + 1 + 1. So I think Kirana plus online plus offline, all three channels will play a very important role. Someone who is able to play a omni-channel, design a strategy, and play a mixture of all this channel will be the winner of tomorrow. So those are the 4 buckets I think will be the winner in the consumption space.
Okay, fantastic. Dhaval, on banking and finance, what is the positioning there? Do you feel that market share will shift between various lenders of the next decade? We're already starting to see a lot more consolidation. Then we've got all these key announcements coming in. On the PSU side, of course, NBFCs, we've seen consolidation. And it seems like with the economic recovery that's expected, this is a segment that's only going to grow.
So definitely there is always going to be a big buzz around financial services sector in our country. The sector was written off exactly 12 months back, or maybe post-COVID around March 2020, that there would be a lot of stress, loans which will get created. And ideally, you look at the last 1.5 months, people have realized that we have come out of COVID very, very well. Means versus many other economies as well, Indian financial services, especially the large banks, have done phenomenal when it comes to managing their asset quality despite the COVID crisis. Coming about positioning part, if one has to consider, we are very bullish on large private banks as well as maybe the large banks and large non-bank lenders as well. And it reflects in our portfolios. We have overweight positions across these stocks. The big picture story, if one has to understand, financial sector penetration in India is still far away from what the developed markets have or are, whether it is lending products, savings product, insurance products. So that story will never get over within the next decade also. The importance is that how and who are the players who are going to achieve or are able to crack or garner higher market share. If you look at the one big picture story is that per capita income, we are close to $2,000. Could possibly rise to $3,500-4,000 over a period of next 7-8 years or over the next decade. This would lead to a big boost or a significant growth in the retail consumption loans. Chanchal just mentioned increased consumption. I'm just saying consumption has to be provided or financed as well. So that would be one part, and definitely mutual fund, insurance penetrations are still very far off from where the developed markets are. So all in all, a very good asset quality outlook versus expectations during March or May 2020 when we did last voyage has surprised, and therefore there has been a good rally in financial services in the last 3-4 months. I think it's still a big beginning from a long-term point of view. I mean, I'm fairly bullish, and that's what our portfolios reflect.
Fantastic. All right, Kunal, what about you for technology in the next decade? And this is one of the most exciting segments as well, given that everyone is jumping on the bandwagon right now and using it across multiple verticals. Do you see the industry back on a double-digit growth path? What's the scale of opportunity that you see when it comes to technology?
Yeah, certainly. I think, from a growth perspective, probably, the double-digit kind of a growth is possible for the next 2 to 3 years. What we've seen is that, there has, after almost like 6 years of a single, mid to high single-digit kind of a growth, we are seeing the revival in terms of the demand for the IT services companies, and particularly in the enterprise IT spending. What is driving is particularly, what is happening in the pandemic. Actually, we've realized that the kind of resilience that IT companies which service, all the global companies across the globe, they have seen that, even during this work from home, in terms of execution, they have managed to, execute and provide that resilience to their clients. And what has then happened is that the enterprise IT spending, there is a demand revival in core 3 areas. So three key trends in the space is with regards to modernizing the core infrastructure. Second is with regards to the adopting the public and the hybrid cloud. Third is the AI adoption and the omni-channel commerce, as Chanchal highlighted that certainly companies which had only one channel of commerce, essentially you need to have that omni-channel. So there is a lot of demand that is happening, and Indian IT companies, if you see, they have pivoted successfully to all these new technology spend areas. And their supply chains are quite efficient. As I highlighted, execution capability, even during the tough lockdown period, was very strong, right? And so after every crisis, so we've seen, in the past during Y2K, that was the first instance. Second instance was 2008 when the financial crisis hit. These tend to act as triggers for the sector from a growth perspective. So this last year's pandemic is certainly the third trigger, where after every crisis, we've seen opportunity for the sector and accelerated growth for the next 2 to 3 years. Be it, all the verticals are certainly increasing their technology spends, be it, banking, retail, manufacturing, manufacturing and telecom. All these are seeing increased tech investments, and hence, from a growth perspective, we are quite positive and remain bullish on the sector.
Okay. Nitesh, coming back to you then, and to the point that I was exploring earlier about how small caps are also perceived to be more volatile or more risky. How do you allay investor fears on that front? And you created such a strong case a little earlier for the kind of opportunity over the next few years when it comes to the small cap universe. What else can really reassure investors when they're thinking about allocating money to the space versus a benchmark, for instance?
Yeah. So basically, I always maintain three key reasons that why mid and small cap throw opportunities. I'll explain these three reasons one by one. Number one, if you look at some of the high growth or the sunrise sectors, India being a developing country, our total market cap of India is like $2.7 trillion, and we have around 5,000 odd companies listed on the exchange. The US, on the other hand, is like $45 trillion, and the number of companies listed there are 20% lesser than what we have in India. So you can imagine the size difference that we and compared to a developed nation that exists today. So many of the smaller industry, sunrise industry, high growth industry, they tend to have these mid and small companies. They are catered by these mid and small companies. So if investor want to have the exposure in those sectors, the only way is to allocate money to the smaller mid-cap portfolios. For example, India's largest tile company is a small cap company. The entire plastic processing sector in India is small cap. The entire consumer durable manufacturing or the electronic goods manufacturing setup is either mid-cap or small cap. PVC pipe companies, they were small cap, migrated to mid-cap, now they are going towards large caps. So, there are huge number of companies and sectors which are there only in this particular space. This is point number one. Point number two is the information gap, which I call it. On an average, if you look at a large company in India is being tracked by 30 analysts, whereas in case of mid-cap, it is tracked by 15 analysts, and in case of a small cap, the number is even lower. So if you do a proper bottom-up job, and because of this information gap and less of tracking, the investment return could be superior. And the last and very important, again, a very technical point, is the ownership structure of the mid and small companies. So I'll give you some data here. FIIs own 17% of large cap companies listed in India. The same percentage is 10% in case of mid cap companies, and it is just 4% in small cap companies. So definitely they are under-owned, and the money has not yet come in small cap, and perhaps in time to come, these things will change. So these are basically the three broad investment case why mid and small cap through opportunities.
Fantastic. I love how you've all sort of really shared some interesting facts and data with us, because I think that really builds a strong case, and it doesn't seem like just a whim, that go for a small cap because it happens to be cheaper. If you actually think they are cheaper, so let's also come to that as well. Chanchal, when it comes to valuations, your sector, that's one where they're always very pricey. So, do you see the valuations continuing at these levels? How do they stack up? Again, what's the case really for buying in? Definitely, if one can't, buy into some of the more premium names in the sector, but want to kind of invest, in the consumer story, then one would have to sort of take a look at some of the small cap and mid cap companies.
Thanks, Abha. Pricey, you called it out. Quality comes at a price. Let me start with that. So quality comes at a price. If you look at Indian demographic, the easiest said 130 crore people, more than 50% below 35 years of age. We've just started consuming. Dhaval was mentioning per capita income, we've just crossed $2,000. Look at the tailwind which we have. The demographic is in our side, per capita income will improve, the GDP growth will come back, consumers will spend, they will leverage and spend. Banking is here to help them leverage and spend. And that's the reason people are just looking at good quality management and good quality consumer story to buy. One thing interesting which we have learned over the last 10-15 years is that the price is a slave of earning. If the earning growth keeps coming in this sector, the price will eventually follow. I can't define a 30p or a 40p or a 50p is good, but I can assure you that the earning growth in this sector for next decade can be a decent 13 to 15% compounding if you're able to pick up the right story and the right sector where the growth is going to come. To give you a few examples, retail is $800 billion market. We don't have any company more than $5 billion of sales. look at the opportunity size in retail. When people built up their retail businesses, both online and offline, what can that be in a decade from now? So obviously the stock here will be expensive. Quality comes at a price. The reason of also being expensive is that these are good cash flow flowing companies. If you look at the amount of free cash flow they generate and the amount of money they are able to reward to the shareholder is humongous. And also the company, if you look at, has shown a history and pedigree of good management, good growth over longer term, and that's the reason the valuation is at what it is today.
Okay, I think that gives me a good segue into into kind of talking, when you're talking about technology and so forth, also getting Kunal in on this, because Kunal, let's talk about the structural differentiators between the global peers and the Indian peers when it comes to technology, and what are some of the key differentiators that you see there, particularly at a time like this when everyone's looking at technology very closely.
So when we look at Indian IT sector and compare that to the global peers, one of the key indicators over the last 2 to 3 years that is starting to emerge out is that the large pool of digitally trained headcount. So companies have invested in the training, and most of their employees are now trained in the new generation digital technologies. And that is essentially helping, at this point in time to emerge as a key differentiator. Second is with regards to the execution and the project management capability that Indian IT basically they have been able to gain share year after year. And in terms of opportunity, if you look at over the last last decade, what is happening is that every time Indian IT, exports currently at about $150 billion. But if you look at the addressable market, the total IT spend is about $1.2 to $1.3 trillion. So we are still, many times in the past also written off. The sector was written off, right? That it's a low single-digit growth kind of a story. But every time we've seen that through the crisis, the sector has really come back, and that is essentially the execution and the resilience that the companies have shown, retailing, and year after year they've gained the market share. I think that is something that is quite a differentiator. And the third is with regards to when you compare the cost at which the kind of services have been provided, that continues to be almost like 40% of the global, or lower than 40% of the global cost. So that arbitrage still continues, and it is likely to continue in the future as well.
Okay. If I were to just go into, Dhaval already knows, I'm going to ask him next. He's smiling. But if I was to go into financials, and again using the example, what we're seeing globally, what we're seeing in India, valuations have been under pressure with fintech, with new, tech platforms, new kind of payment companies as well. Even here in India, lots of competition coming in from tech giants and payment companies, fintechs and so forth. So how do you see the space really evolving then, Dhaval, over the next few years, or even over the next decade if we were to see? But what's the longer term outlook? Would you now start to choose stocks a little differently, keeping that in mind?
Definitely stock choosing or selection of stock is a different subject, but just to give you a market perspective, your question is pertaining to fintechs versus banks, or maybe comparing what is happening in China, where fintechs have emerged very strong, US, the fintechs have emerged fairly stronger, or they've got a big market caps as well, and where does India go, right? So if you look at India's large banks, right, all the large private banks, even SBI, if one has to look at, they are market leaders when it comes to consumer lending or retail financing. Especially, most of them have done very well when it comes to the top cities in the country, or tier 1 cities when it comes to getting the lending penetration. So a big proportion of under penetration in the country is largely in semi-urban and rural markets. Fintechs today, if they have to make money and not spend money, they will have to lend money to people who are not getting easy money from banks, or they are not able to borrow from banks, and they'll have to go to higher risk category. So they are actually expanding market and not competing with banks. So that is a big point, number one. Now you look at what is banks and how are they operated, right? So they come with a very big regulatory moat. One, they have an access to low cost deposits or time deposits, term deposits, what we call, which none of the other companies would have at this juncture because of the regulatory reasons, or basically banking license. So they have a very strong liability franchise. You look at last 10 years, other than COVID crisis, retail NPLs have been very low. We have a very strong underwriting practice by most of the large private banks, and including even SBI, if one has to consider in the public sector space. Even the larger NBFCs, the likes of Bajaj Finance and others, they have demonstrated a stupendous retail asset quality over the last decade. So the point is, again, you will have to showcase the same underwriting capabilities if you have to compete with these large lenders. Then the third most important point is they right now already own the customers. So from here on, you first have to compete on regulatory aspect, which is not easy. You will have to have your own customer, whereas I mentioned is only going to be on the underpenetrated and more risky segments, which would be tier 3 to rural centers. And you will have to constantly innovate. For banks, the bigger picture is whoever continues to invest on digital capabilities. And today, what I understand after the last 5 years of emergence of the likes of Paytm, Amazon, and many other tech giants in the financial services business, the outlook or the approach will be more collaborative. They don't want to fight with each other because the market is fairly large, unlike other geographies. So maybe collaborative approach, there could be some profit share between the two, but the underpenetration will lead to very high profit growth, if not higher return ratios versus what the last decade showed. So in simple words, if I have to borrow from Mr. Aditya Puri's one of the interviews, he very clearly said that banks cannot be replaced by the big tech or fintech companies because they do not understand regulations and they neither know how to deal with the regulators. And most of these banks, which I am talking about, the larger ones, are very well ranked with regulators in terms of following rules and innovating as well. So that's the big picture. I think the next decade continues to be difficult and challenging, but ultimately the large banks will continue to remain relevant, and they will strive. They will actually thrive forward.
All right. Nitesh, what about cement, metals, particularly with the government's focus on infrastructure?
Yeah, so basically cement, infrastructure, and anything and everything related to capital spending should do really well. And you asked me previously, like, what are the subsectors which should ideally do well in coming years? I would like to club the question along with it. In the sense, we are actually super bullish on the entire manufacturing setup, because the way India created in 90s, we created the IT industry in the decade of 2000 to 2010. It was auto and pharma. I think for the next decade, with the kind of focus that this government has on the manufacturing side, the next decade is going to be manufacturing this thing, because the share of manufacturing in India's GDP has been quite stagnant for last few years. And with the PLI scheme in place, there are like 12, 13 sectors where the government is focusing to propel the manufacturing. Just to give you brief mathematics, the government want to give incentive of around 2 lakh crore at the rate of 5%. So basically, if the scheme is successful and execution is proper, this alone could generate around 40 lakhs crore worth of manufacturing revenue in next 5 years. So that's the kind of opportunity we are looking at. So definitely some of the sectors included there, be it electronic manufacturing, API in pharma, technical textile, special steel, auto ancillary, and there are like host of other companies, other sectors which are included in PLI. This is on part one. And on the infrastructure side, definitely this budget had showed that the fiscal stimulus is there and the infra sector should do well. Cement in particular, we at the Aditya Birla Mutual Fund have been super bullish for last few years, and it is actually reflected in our positioning versus the benchmark weights. The reason being, cement offer the cleanest play on India's infra story. All the companies are net cash balance sheet companies, high quality management, and a structural growth industry. One fact is that 70% of India's cement capacity is owned by 5 large groups. So that kind of concentration we have. And hopefully in the coming years, along with the housing revival and the real estate revival, plus thrust on infra, cement should continue to do well.
All right. Kunal, on the IT segment as well, given the kind of outperformance we've seen in IT over the last 3 years, what are the kind of return expectations that one should have? And I think there are a couple of questions also coming in on the kind of scope of investment there.
So from let me address the second question first with regards to the scope of investment. So IT in India, technology, essentially we've so far been able to invest in the space on the IT services side in particular. And essentially, that has been a story that technology spends globally. What's important is that, over the next coming decade, I see that the investment scope in the technology sector is going to widen. We'll have, so last couple of years, if you see, there has been, companies who have been domestically focused, who are in the internet slash, platform play. Okay. And they've done really well. Looking at the success, we do see that, there will be more companies who are go public, be it in the large. So media reports do tell us about large food tech, insurance kind of companies are planning to go big. So while the proposition of the IT services will continue to be solid, but I think investors will get opportunity as new companies come and the whole digital India, right? What we've been talking about, that there has been a digital wave in India and the whole transformation is happening. So we'll see, domestic focused technology companies also coming in, having investors getting that opportunity. From an investment, so from a first question perspective, so obviously, IT sector last 3 years compared to the market, it has done very well. So the obvious question is that, what from here, given the valuation re-ratings that has happened. My view is that given the kind of growth outlook, the kind of valuations that are there, so sector trades at almost like a 24, 25 forward PE. I think, that should likely sustain because the growth outlook is fairly positive. Second important point is that these are fantastic, cash flow companies. And last 3 to 4 years, we've seen that, tier 1 companies, they've been paying almost like 80 to 100% of their payouts, as in net profits as payouts, either in form of dividends or in form of buyback. So, I continue to believe that, double digit or, early double digit to mid double digit kind of, return expectation is fair. Probably near term, it could consolidate as we see, domestic cyclical recovery that is happening. But certainly, year after year, we've seen that the kind of resilience that, tech companies, because of the cash flow and the steady growth, that should continue.
Okay. So we've just got a few minutes left to go, so I'll just take closing comments from you guys. And Nitesh, let me start off with you, just to kind of sum up some of the opportunity that you've described in great detail, actually. But just in terms of the fact that, there are key processes that are followed that help you really go out there and find these gems that you do see an opportunity, as you've outlined with so many of those facts for not just the near term, but the longer term, despite the recent run up that we've also seen in the overall market, and anything else that you'd like to leave us with today.
Yeah, so essentially, the summary of the discussion, I would like to make a final comment is that there are opportunities in mid and small cap, even though they tend to be little volatile, but over a long period of time, if you do the job consistently, I think they create, tremendous alpha over other large cap or other equity instruments. One thing I would like to make about our Aditya Birla Sun Life Small Cap Fund is that we are absolutely true to the level. We have 75% of our total fund in pure small caps, and the balance 25% in mid cap, and hardly 1 or 2% in large cap. I think the small cap proportion of 75% is among the highest within the industry, and therefore we can proudly say that we are truly running a small cap fund in a right fashion and right way. Yeah, thank you very much.
Actually, that's great. I'm glad you mentioned that as well, because these differentiating factors make all the difference. Chanchal, when it comes to, of course, with the consumer space as well, valuations will always, of course, continue to be a question mark. But outside of that, and we discussed that in detail, we've seen the impact the pandemic has had on the sector as well, with certain segments doing better than others. But anything that you'd like to share with us as we wind up?
No, thanks, Abha. So you have summed it up well. The only point is that companies will be able to adopt themselves digitally. Post-COVID, the digital adoption will play a very important role. So companies will be able to adopt themselves digitally, will be the winner in this next decade. You have to watch out for what are the changes happening and which are the companies and how are they adopting. One thought which I had in mind when Kunal was talking about digital is that, when companies are talking about precision marketing, that we have heard word of big data and how companies are analyzing. So companies are analyzing where Abha is shopping, what she's shopping, what she's eating, and they'll be able to market you based on those data. So that's the in-depth work which is, and they'll be able to help you premiumize next time you are buying the same article. So companies who are able to analyze this big data, use that data as a means to premiumize the customer, sell right into the customer, will be the winner over the next decade. We'll keep an active watch on it and we'll find the winners, have it in our portfolio.
Fantastic. Dhaval, banking and finance, and that's going to be an interesting one because criteria is going to change. It's already changed, with so many regulations coming into play and everyone being a lot more careful. How do you see things evolving?
Sorry, I was on mute. Things keep evolving, keep changing, and being an economic linked sector, we have the economic volatility continuing in the sector. Definitely things are not in the same manner to analyze or select. You would ask this question, I didn't answer it clearly maybe. From here on, if I have to look at stock selection or how do we look at the markets and small cap as well as in general stock ideas, we'll have to now focus on companies which will be proxies to some growth avenues within the economy. Now, whether it is digital space, fintech lending space, payment space, though payment sector has not made enough money, but even that is a customer acquisition tool. How do you then monetize that acquisition of customers you've done over the years? Focus on evolving business model. One important stuff which would be very important to know is whoever invests very well in technology, digital capabilities would gain a lot. I just want to give you one simple example. Maybe a lot of people would be able to relate to. Early 2000s, when all these current large private banks were started in 95 to 2000 era, they brought in core banking solution. Now, today in such a digital environment and technology environment, core banking solution is old technology, but that was something which led to a sea change for these banks, differentiated that again, public sector banks also implemented the same thing and everybody benefited out of it. Same could be the fintech angle across, whether it is insurance sector, technology, it means disruption, lending, deposits. I think the same could be for the entire financial services or maybe many other sectors, as Chanchal was talking. So this is how one will have to look at perspective about the size or the scale the company can achieve. And the third big picture here is we'll have to look at the companies from the global perspective when you look at valuations. So when we mentioned GAP, right, Nitesh was talking about Russell Index. Chanchal was talking about the penetration of his companies in terms of size of the market they have achieved even now versus the demography. I would like to conclude here is that we'll have to look at valuations of all our big or small companies, not just on the price to earning or whatever respective ratios, but also from a global perspective where they stand. And therefore, it makes a lot of sense to look at small cap space. The last example is Bajaj Finance, a stock, or an HDFC Bank stock, right? It began in some small cap portfolios years before. In fact, you would Bajaj Finance, the first time we invested as a house, we've already seen and we are still, all of the schemes are largely holding, and we've seen close to 45 times return in the last 7-8 years. So that is the possibility, reams of the possibility of ideation which comes from small cap fund. So I reiterate what Nitesh mentioned, and because 10 brains are working behind that. So this is the most bigger differentiation factor versus the market and the other fund houses. So that's it.
Wonderful. Gentlemen, thank you so much for sharing that with us and for coming together today to really give us an in-depth look at really what goes on behind the small cap fund. That was very meaningful. Thank you.